Okay, now it is done.
Thank you, sir.
Right, so we discussed a tender offer last week, and there was an illustration on this. Yes, this one. And now the next part, which is a rights issue. And there was another one in between, an IPO and a rights issue, which is placing. I explained, if I remember correct, last week. Is placing an order with a party. It can be an individual, or it can be even a company. Placing the entire quantity with one party, so that for the company it will be very easy to deal with only one party, and in terms of even the cost. Then let's discuss the rights issue part. With these are the rights offered to existing shareholders, and an offer to existing shareholders to buy shares of the company. This will not be open for the public. It will only be given to the existing shareholders, and the number of shares offered to each existing shareholder will be based on the number of shares that they possess, they own. Therefore, this is based on or rather based in proportion to their existing shareholdings. And another feature here, it is always issued at a price which is less than the current market price, in order to motivate the existing shareholders to buy those shares. The right the existing shareholders have to subscribe for those shares, which is not available to outside investors, is known as preemption rights. Why this is very common, or it is a cost-effective option to the company compared to public offering, much cheaper, far cheaper to organize than a public share issue. But of course, may be expensive than a placing. Placing is the most cheapest one, and you don't need to get the consent of the stock exchange or the shareholders of the company. You just need to at the director's decision. It will be just a director's decision. No approvals required. Right. So, the other characteristics of a rights issue: after the rights issue, or after the announcement, not the rights issue, after the announcement of the rights issue, usually there is a tendency to for share price to reduce. Right now, there are two concepts to study here, or one important calculation, theoretical rights price calculation. Of course, I did this in presentation number 2 also. We had a question that, and I did the TRP calculation that time. Another term to remember: when the rights issue is announced, all existing shareholders have the right to subscribe for new shares, and so there are rights attached to the shares. And once it is issued, if you are existing shareholder, you have a right to subscribe, and those are known as cum rights. And on the first day of dealings in a newly issued shares, soon after those are issued, the name we use is X rights, because you don't have a right now in order to buy further shares, because you have already exercised that right. So the cum right is when the rights are attached to your existing shares. X rights means once you have exercised those rights, and now it is without any right attached. X rights shares. The TRP calculation I remember we did a question, and that time I explained the formula, but it was not, the formula was not available in that presentation. The formula is, this can be calculated in two ways. Let me explain the first method. Assume, let me take the second one. You have two shares of a company, and the company has offered one right share for two. So which means you are eligible to get only one right share, one for two existing shares. So if your share capital is 2, then the number of shares that you have right now, N, capital N, is 2. Multiply 2 by the current market price before the rights issue, into current market price of a share before the rights issue, which is cum rights price. Then you get the market capitalization, your value of the shares, plus the amount that you have to pay to buy the new rights share. Your numerator is market capitalization plus the price that you have to pay to buy a new share. Divide this by, in this example, in my example, 2 plus 1, existing 2 shares, and there will be one more, 3. The denominator is total number of shares after the rights, 3. You'll get the X rights price. This is based on, the second formula is based on the minimum number of shares that you should possess in order to get one new rights. So assume you have 1,000 shares with you, but the ratio is 2 to 1, which means you are eligible to get 500. One new share for 2 existing shares. So you are eligible to get 500 new shares. Your existing shareholding is 1,000. So you don't need to use all 1,000 here. The first formula is that, in fact, taking the entire value of the shares. If not, you can use, now in the example, you need only 2 to get 1. So go on the minimum number of shares that you need to get a new share. Or still you can use the entire 1,000 into the current price plus the amount that you have to pay to buy that 500 shares and divide that by 1,500. Still, you'll get the same answer. So that is on taking the entire shares into consideration. Or from the company's point of view, if you want to calculate the market value of the shares already issued, the total number of shares issued by the company existing into the current market price plus the proceeds of the new shares, all new shares, divide that by the number of shares after the rights issue. So any formula can be used. The answer will be the same TERP answer. So the term TERP means the share price after the rights issue. And that price is usually less than the existing price because rights shares are issued using a discounted price. Therefore, the TERP is always a diluted price, which is between the previous market price and issue price. Issue price is always less than the existing price. Therefore, the TERP must be between those two extremes, the previous market price and the issue price. Right. Now, as explained, in order to attract the existing shareholders, these new shares must be issued at a discounted price. Point 1, to make the offer relatively attractive to shareholders, new shares are generally issued at a discount on the current price. Another calculation and in other than the TERP, we have to assess the value of a right also, which is the difference between the TERP and the issue price. Right now, you'll be able to easily understand using this graph. Assume the market price is, say, current market price before the share issue, rights issue is 10, and we have decided to issue the new shares at a discounted price of, let's assume as at 6. So 10 and 6. The difference of 4 is given as a discount to encourage buying those shares. Discount to encourage take up. Right now, after the rights issue, the TERP ex rights price must always be between 10 and 6. This is the price now. Approximately assume 8. The TERP is 8, assume. X rights price value afterwards. So the difference between the X right price and the issue price, which is 8 and 6 in my example, is known as value of a right. The third formula is value of a right per existing share, which is the second answer, which is value of a right divided by number of shares needed to obtain a right. Say, for example, if you need 2 shares to get 1 right, divide the value of a right by 2 to get value of a right per existing share. Number of shares needed to obtain a right. So if the question is for us to calculate the value of a right per existing share, you have to follow the order. You first need to calculate the TERP, then value of a right, and then only value of a right per existing share can be calculated. Quickly do a few questions on this now. MNS has an issued capital of 2 million shares having a current market value of $2.70 each, which makes a rights issue of 1 new share for every 2 existing shares at a price of $2.1. Calculate the TRP. Okay, what's the answer? Use the chat box. Chat isn't available. Oops, why is that? Please check whether you all can use the chat box.
It's not available, sir.
Okay. Let me calculate using the minimum shares required. So you need 2 shares to get 1 minimum, which makes actually 1 new share for every 2. So the minimum number of shares is 2, and the market value of those 2 is 2.70, 5.4, plus the amount that we should pay to buy a new share, which is 2.10. 7.1 numerator, divide this by n plus 1, 2 plus 1 new shares. So altogether 3. So TRP is 2.50. I hope all have got this answer. Now this is based on the minimum number of shares that we should own to get 1 rights share. This can also be calculated using the total number of shares of the company. Or the third method is the total number of shares a person has. So any method as explained earlier. Now let's take the 2 million shares. From the company's point of view, the company has 2 million shares. 2 million into the current market price is 2.70, and they will be able to collect how many shares? One new share for every 2 means 1 million shares at 2.10. They'll be able to collect 1 million new shares into 2.10. So this is the numerator, 7.5 million. Divide this numerator by the total number of shares. The same answer you'll be able to get. They currently have 2 million shares, and they'll be issuing 1 million new shares n plus 1. 2.5, same answer. So the second answer is based on the total shares of the company. The first answer is based on the minimum number of shares we should possess to get one right share. Same figures are no different. Tesco announces a 2 for 5 rights at $2 per share. They currently have 10 million shares in issue, and the current market price of the share is 2.170. Calculate the TRP. What is the value of the right and the value of the right per existing share? Second and third formula. Please use the mic. If the chat box is not working, please share your answer. Answer, please. How much is the TRP? Line teaching is very difficult. How much is the TERP?
$2.50.
TRP, okay. And then value of the right?
So is it 20 cents?
20 cents. If the TERP is 2.5, yes, the issue price. You just need to compare the issue price with the TRP. Yes. If the TRP is 2.5, yes, value of the right is 20 cents. Let's calculate the TRP first. Minimum number of shares basis, we need discount ounces 2 for 5. So the minimum number of shares we should hold on. It's you said 20 cents, right? I'm sure you must have compared TRP with the issue, the current market price. If your TRP is 2.5, for you to get a 20 cents answer, you must have compared that with 2.7, which is the current market price. Value of a right is the difference between the TRP and the issue price. So let me first calculate the TRP. See whether it is 2.5. The minimum share basis, which is we need minimum 5 shares to get 2 new rights. So yeah, so that's the minimum. You can't have 2.5 shares to get 1 share. There are no 2.5 shares. Therefore, the minimum is 5. So the market value of 5 shares, 5 into 2. Current market price is 2.7. The market value of current shares, and how many new shares 2 will be purchased, or for 2 shares money will be paid, how much it will be, 2 per share. 2 shares at $2 each. 2 shares at $2 each, 4. And the numerator is therefore 17.5. The denominator n plus 1 is existing 5 shares and have purchased 2 shares, 7 shares altogether. 17.5 divided by 7. Yes, TRP is 2.5. Let me, for the benefit of others who have used the total number of shares, they currently have 10 million shares. So the current market price, 10 million shares into 2.7, 27 million. And the money that will be collected by issuing the new shares, how many shares altogether they will be able to get? They have 10 million shares. They have 10 million shares. Divide this by 5 and multiply the same by 2. So altogether 4 million new shares. 4 million new shares at an issue price of 2. The numerator would be 20, these 2 together, 35 million. 35 million divided by the total number of shares after the rights. They had 10 million and they issued 4 million, altogether 14 million shares. Divide 35 million by 14 million shares, the same answer, yes, 2.5. Now, the second is value of the right. This is TERP. Which is the difference between the TERP 2.5 and issue price. Issue price is not 2.72. The one who shared his answer, did you understand? It's not 0.2, it's 0.5.
Yes, sir.
Right. The third one is value of the right per existing share. Value of a right divided by the number of shares required to get a right. Now please note here, the formula here is the value of a right, which is 0.5 divided by number of shares needed to obtain, remember, a right, which is one share. Number of shares needed to obtain one new share. Now, in this question, now we can't go on 0.5 basis shares. Technically, to get one new right share, we should own only 2.5 shares technically, but there are no 2.5 shares. Therefore, what we have to do is, yes, if you divide 0.5 by 2.5, you will get the answer, but correctly it should be 0.5 divided by 5 and multiplied by 2. Yes, you'll get the same answer. 0.5 divided by 2 and multiply the same by 2, which is 0.20. Now, even if you divide 0.5 by 2.5, you will get the same answer. Since there are no 2.5 shares, I did not do it, but if you do it, you will get the same answer. Yeah, 0.2. So therefore, the correct way is divide it by 5 and multiply it by 2 to get the value of the right per existing share. Pre-discussion. As indicated in the table below, Chris PLC earns 2 million after tax and has 1 million shares outstanding. Earnings per share are thus 2 million. Correct. Sorry, $2. 2 million divided by 1 million is $2 each EPS. And the stock sells for 20. Current market price is $20, which means the price earning ratio, market price divided by EPS, is 10 or 10 times earnings, correct? 20 divided by 2 PE ratio. That is, the price earning ratio is 10. Yes, it is correct. To fund a planned expansion, the company intends to raise $5 million worth of new equity funds through a rights offering. To execute a rights offering, the financial director of Chris PLC will have to answer the following questions. What should the price per share be for the new stock? How many shares will have to be sold? Number 3, how many shares will each shareholder be allowed to buy? Also, the other directors will probably want to ask what is likely to be the effect of the rights offering on the per share value of the existing stock. SOFP common stocks 5 million, retained earnings 10 million, financed by, invested in non-current assets of 15 million. Okay. Statement of profit or loss, earnings before tax, then the tax of 34%, and the net income of 2 million. Other notes, shares outstanding 1 million shares, earnings per share is 2 each, 2 million divided by 1 million. Market price, which was given there in the previous paragraph, also 20. And the last one must be total market capitalization. Let me check. Yes, the total market value is 20 million. Chris wants to raise 5 million in new equity. Suppose the subscription price is set at $10 per share. Notice that the subscription price is substantially less than the current $20 per share market price. Right, so it's not a difficult question though, because you just need to apply to see how many shares we should buy based on the ratios given. So they have decided the subscription price as 10 per share, though the current market price is 20. Now they have decided already the subscription price as 10, but what other options available if they decide the price of a share as say for example 20, and now they have decided it as 10, and let me take another one, let's take it as 5. If these are the prices, 20 is the current market price, they have decided it as 10, and they can give a $15 discount, and if necessary issue at 5. In that case, the number of shares needed would be how many? $5 million is the requirement divided by this value, option 1. And in our case, the answer is this one. Number of shares needed to issue would be 500,000 new shares. The rest is not required. I just typed those for your information, because the question is what should be the price per share for the new stock. It is given there in the question itself, because this question had some other areas which was taken out. So how many shares will have to be sold? Yes, minimum at that price, 500,000 shares should be sold. Right, on the same thing, calculation, if I show the number of rights needed, $250,000 shares means they have 1 million shares already, 1 million shares at the moment before the rights, which means 4. For each 4 existing shares, 1 share should be issued. Likewise, the other 2, for our selected option, 500 shares will be issued, which means for existing 2 shares, 1 will be issued. In the last option, 1-to-1. How many shares will each shareholder be allowed to buy? It will be only each shareholder how many shares each shareholder will be allowed to buy. How to interpret that? One for two existing shares. Also, the other directors will probably want to ask what is likely to be the effect of the rights offering on the per share value of the existing stock. What is that question? Now assume, okay, let me further explain this. Assume a shareholder who has two shares. A shareholder who has two shares, what will be his position? Before the rights.
He will be getting one new share.
Yes, before the rights, what is his market capitalization? Before the rights, his market capitalization would be, he has two shares and the share price is 20, right? Was it 20? Yes, the stock sells for 20. It is 20. Therefore, his total value of those shares is 40 before the rights. After the rights, he has he has 3 shares now, and the wealth or the value of those shares. Calculate how much it would be. Basically, value of holding, value of his holding. Let me. From your previous knowledge, those who have done this area before, the value of holding, will that be increased or will that be the same or will that be decreased? What do you all think? Should that be increased or decreased or no change? How to answer this question? What is likely to be the effect of the rights offering on the per share value of the existing stock, which is, the examiner has used many other terms. What is it? It's TERP, the price of a share after the rights issue. How much it would be? Now apply the theory that we studied before for this question data. Insert the TERP and calculate the value of holding. Answer, please. How much is the TRP? No answer still? Wasting time. TRP is 2 shares at 20 plus 1 new share. The numerator is 50. 50 divided by 2 plus 1. $16.67. Therefore, the value of holding after the rights, 3 shares into this value. Earlier, before the rights, he had a value of holding 40. The same shareholder after the rights has a holding of 50. Now, please note again, please make a note. The question is, I specifically use the holding. It is not the wealth of the investor. The wealth calculation we'll do in a different question. The wealth will not be increased on a rights issue. That's a different concept rather, but the holding, value of the holding will be increased. Other two calculations are not required as per the question, but let me do that as well. Value of a right. The TRP minus issue price. 6.67. Value of a right per existing share. How many shares required? 2. 1 for 2. So divide this by 2. 3.33. Value of a right per existing share. TRP from the company's point of view, they had 1 million shares and the market price is 20. Issued 500,000 shares at the issue price of 10. Numerator. Denominator is earlier shares 1 million, new shares 500,000. Using total shares. Right. Before the convertible debt instruments, we take one more question, which is not there in the presentation, but I think if I'm not mistaken, I have shared that, or rather I have uploaded. Extra question, rights of yes. MNS has issued capital of 2 million shares, having a current market value of 2.7 each, which makes a rights issue of 1 new share for every 2 existing shares at a price of 210. These are the details we used in question number 6. Was it 6? Is it 6? Yes. A shareholder, Peter, had 1,000 shares in MNS before the rights offer. Calculate the effect on the net wealth of Peter of each of the following options. Take up the shares, which means exercise those rights by paying. Peter has purchased those shares. Second, sell the rights. And number 3, do nothing. Those are, by the way, the options available for a shareholder, either to exercise those rights, either to sell entirely those rights, and then do nothing, or even fourth option can even be selling part of those rights. So, which is almost covered in part 2. So mainly there are 3 options available for a shareholder: to exercise those rights, to sell those rights, or to do nothing. Now, it is not the shareholding only now. The question is on the wealth of the person. Now, please calculate the wealth of the shareholder before this rights issue, which is not a requirement of the question, but in order to compare this, please calculate the wealth of the shareholder, Peter, before the rights issue, which is very straightforward. Wealth before the rights is how much? What is the wealth before the rights? Come on.
1,000 shares into $2.7.
Yes, exactly. So 2,700 is the wealth of this shareholder before the rights. 8 point. These are extra questions, no? Thousand shares into 2.7, 2,700 wealth. Right now, the first option is take up the shares. Rights issue one new share for every two, which means after the rights, the total number of shares will be 1,500 shares. Now, if you remember the TERP of the same question, 8.6, these are the details of 8.6. TRP is how much it was? 2.5, right? Was it 2.5? Yes, 2.5 was the TRP. Yes, 2.5 was the TRP. So let me write that TRP, TERP, which is the value after the rights issue. Same details, therefore I'll copy from question number 6. If the value of a share after the rights is T 2.5, the shareholding is value of holding is he has 1,500 shares into this 3,750 as expected, similar to the previous question. Remember the previous question, the value of holding went up by 10 million there, or 10. It was 40 earlier, and now after the issue it was 50, so it went up. Likewise here, 2,700, now it is 3,750. But there was an outflow. This was not given free. Peter paid cash. How much he paid? A payment of, he paid for 500 shares. The price, how much was the price? The price of 2.10. That was the issue price. So the wealth of the person has decreased by 1,050, and the total wealth is therefore after the rights is the same value. If you can, as you can see 2,700. It should be the case. Wealth before the rights was 2,700. Wealth after the rights is also 2,700. B, sell the rights. Now, sell the rights means he has not subscribed for those new shares, which means after the rights issue, his shareholding will be based on the previous shares of 1,000 shares. value of those shares would be, his holding would be, value of holding would be after the rights, because he has not subscribed, but others must have subscribed. And therefore, the price is a common price of 2.5, which is the price after the rights in common terms, into he has only 1,000 shares. So his value of holding is 2,500. But he has sold those rights, and the cash received from sale of rights should be added. Value of a right into value of a right into, how to get this answer, value of a right into number of shares, number of rights. Value of a right of that question was how much? The difference between the TERP and the issue price, which was 2.10. Number of rights, 500. These two together is the wealth, which should again be equal to the wealth before the rights. Yes, it is 2,700. Do nothing. Simply, the shareholder has ignored the notice of the company. Then what? The value of the holding would be 2,500. No further transactions. The wealth is now less. He has ignored it. Therefore, the wealth has come down because the current market price is the TRP, which is less than what it was earlier. Therefore, his market capitalization is less. Question number 2, please answer quickly. If a shareholder owns 1,200 shares worth 5 each, in the 1-for-4 rights issue, he will be offered 300 new shares at $4 each. A shareholder receiving notification of a rights issue from an entity has a number of options available. Those 3 options, as discussed earlier. Calculate the value of shares of each option. it is not the value of shares of each option, only the wealth as well. Calculate the value of shares of each option and the wealth. Answer for this three options and the wealth before the rights also. How much? Can a student please tell me the answer? 1,200 shares, $5 each, which is 7,200 before. Yeah. 6,000, not 7,200, 6,000 wealth. Take up the shares, TRP would be how much? What is the TRP answer here? I don't need to do if
4.8.
you, I don't need to do if that answer is correct. Any other student can, as another student can confirm. 4.8 issued at 4, current is 5. And let me quickly do. Five into s- 24 divided by 5 is 4.8. After the rights, he has 1,300 shares. So the value of holding is 6,240. The payment is for 300 shares. the price of 4. No, 1,500 shares at a price of 4.8. 1,500. He had 1,200 shares, issued 300. So the total shareholding is 1,005 into 4.8. So the wealth is equal to the previous. Value of his holding is has 1,200 shares into 4.8. Cash received from the rights. How much is the value of a right? TRP minus 4.8 minus issue price of 4.8. 0.8 into number of rights 240. These two together, that should be added, is 6,000. Do nothing. Value of the holding 1,200 shares at its TERP 5760. The wealth will be reduced. Yeah, shall we do the convertible bonds after the break? Yep. Yes, we'll take the break now, and then after 20 minutes, we'll start. shall we start now? We had 49 or 50, but now we have only 42. Okay. Convertible debts. These are debt instruments at the time of the issue, but issued with an option to convert those into equity on redemption. So remember, it is an option given to the holder. A form of loan note that allows the investor to choose between taking the redemption proceeds or converting the loan note into a preset number of shares. So the option is with the holder. The holder can either select the cash option, or the holder can select the conversion option. Right. So the area here is what option we should select if you are the holder. How to decide to calculate the cost of those convertible debt. Basically, to calculate the cost, what you should do is calculate the value of the conversion option using the available data. There are 3 steps to follow. Compare the conversion option with the cash option, because you have both available, and you should go for the higher in terms of the value, for the higher value. If the cash option has a higher value than the conversion option, you should select that. If the conversion option has a higher value, then you should select the second. Then finally, if the cost of those convertible debts is required in order to calculate the cost, calculate the IRR of the cash flows for redeemable debts. Now, I hope you all remember the cost of debt calculation, which was done before the business valuation. At the time of the business valuation, before the acquisition, mergers and acquisition, under the business valuation, the cost of debt is KD is equal to interest into 1 minus T over the value of that instrument today, P0. That will give you the value of a irredeemable debt instrument. Remember, it is the cost of a debt of an irredeemable instrument. Those who have missed that lesson, the cost of debt KD is equal to the interest portion into 1 minus T. Divide this by the value of a instrument. The today's value P0 is into 100 will give you the cost of debt as a percentage. But this is applicable only to irredeemable debt instrument, because you take the interest of a 1 year and it is perpetuity then. those are irredeemable. Therefore, you get it over a perpetuity period, no end. Therefore, we take the interest of 1 year and divide it by today's market value of that instrument. Always X interest value, always P0 is always X interest, and multiply it by 100. Right now, converting those into shares means it is a redeemable instrument. The cost of debt of a redeemable instrument is different. If the instrument is a redeemable one, the previous formula cannot be used. It is the IRR formula. You just need to calculate the cash flows. What are the cash flows on a bond certificate? A debenture note or bond, the interest portion and the capital. That's all. So those are the cash flows. So consider those as in and out flows and calculate the IRR, which is the cost. So we'll do this irredeemable part today with this convertible instrument, because the convertible one is which is a redeemable instrument. Either you can get cash, your capital invested amount, or you can get shares of another company. In both cases, the previously issued bond will be redeemed. Therefore, it is considered as a redeemable. IRR is the cost. We have a question on concentrate. The company has issued convertible loan notes that are due to be redeemed at a 5% premium in 5 years' time. 5% premium in 5 years' time. The coupon rate is 8% and the current market value is 85. Alternatively, the investor can choose to convert each loan note into 20 shares in 5 years' time. The company pays tax at 30% per annum. The company's shares are currently worth $4 and their value is expected to grow at a rate of 7% per annum. Find the post-tax cost of the convertible debt to the company. Right. Please read again and read those steps as well. First one, calculate the value of the conversion option using available data. Read this question again. Okay, what is the conversion option and the redemption value of this case? The redemption value in terms of cash payment, cash redemption value would be, the question says, a company has issued convertible loan notes that are due to be redeemed at a 5% premium in 5 years' time. So you will get it at 5% premium. The nominal value of a bond is 100, thereby the value would be 100 into 1.05 or 105%, which is 105. Cash redemption value. Conversion value would be how much? Alternatively, the investor can choose to convert each loan note to 20 shares in 5 years. 20 shares in 5 years time. The company's shares are currently worth $4 and their value is expected to grow at a rate of 7% per annum. Now, the value of those shares would be, as of today, it would be set 20 into 480. What would be after 5 years? Mathematics. Calculate and let me know the value. Today's share values are, it is currently at $4 each, thereby 100 loan note holder will get 20 shares. If you calculate using the today's market value, it is only $80. 20 into 4 times. What would it be after 5 years? Students, what is the value? No answer?
5.61.
How much?
5.61.
5.61 per share. How did you get it?
4 into 1 plus 7 into 5 times.
Correct. Correct. So you just need to apply the growth. The conversion value would be, yes, exactly, 20 shares into 4 is the today's value, P0, but this should also be multiplied by 1 plus G power N. 1 plus G. G is, it says 0.7 or 7%, 0.07 power in number of years. We have 5 years. So I have calculated the total values separately. If you calculate, as he said, yes, if you apply this to $4, 1.07 power 5, you should be able to get that answer. Yes, 5.61, which is the value of a share after 5 years. Multiply 5.6 by 20 shares, which is the previous answer, 112.2. So I'll show both. And the second decimal is 0 raised. So 5.61 is the per share value after 5 years into 20 shares. Or straight 20 into 4 into 1.07 power 5. Right, now the next option is, or rather step 2 is to compare these two. Now, if assume you are the shareholder, you are the bondholder, you have the option of collecting 105 from the company, or you have the option of converting those into shares, which has a value of 112.2. Step 2 is to select the option which has the highest value. Compare the conversion options with the cash option. Assume all investors will choose the option with the higher value. So in this case, you have to select this option 2, which is the conversion option. Right. Now I'm collecting data for IRR basically. Select the highest of the two values as the amount to be received at year 5. Now you will not be collecting 112.2 as a cash inflow, but in order to calculate the cost of the debt instrument, you need to assume that as a cash inflow, because you anyway will be collecting shares worth 112.2. The highest option should be selected. Irrespective of the option, whether it's a cash or shares, you have to assume this as a deemed inflow in year 5, which is 112.2. That is for the purpose of estimating the cost of debt instrument. Now, since the question requires us to calculate the cost, let's calculate the IRR. I'm repeating, you will not be able to collect 112.2 as a cash inflow. But for the purpose of IRR, it should be identified or treated as a deemed inflow. Right, now what are the cash in and out flows of this transaction? Assume you are an investor. For you to buy this loan instrument today, how much you should invest, which is your investment in year 0. Consider you are a holder of one loan note only. If you are a holder of one loan note, how much you should pay today, which is your outflow. Then that's year 0. Then year 1 to year 5, you will be able to collect interest from the company. Inflows. Then in the last year, year 5 again, you will be able to collect this deemed inflow of the selected option, the highest option of 112.20. That's all. So 3 cash flows: investment, inflow interest, inflow redemption. Investment, which is your market, which is the market value today, year 0. And you can even use the annuity factor. Annuity factor for the interest only, and year 0 and year 5 redemption value, the discount factor. But I'm going to use the discount factor for all. So the investment, which is today's investment, we have to invest how much? Today's market value is 85. Outflow. Interest payment, how much it will be? What is the interest rate? Coupon rate is 8%. Coupon rate is based on the nominal value, which is 100 into 8, but there is a tax impact also. 1 minus t, t is 30. 1 minus 30. 5.6. Yes. So 5.6 annuity factor can be used here if necessary. 5.6 into 5 years interest payment. Then the capital repayment by way of shares, but we assume it as an inflow, which is 112.2, the selected highest option. Selected option, 5th year inflow. Net cash flow. Let's use a discount factor of say 10% first to see whether we get a positive or negative one. Nine zero nine 826 751 683 and 621. Please check if you have the discount factor table. I don't have it. quickly check whether this is correct. Six, 751, 683, yes. 621, correct. Then the discounted cash flow for the present value, 85 into 1, and the NPV. A positive NPV of 5.91. And 0.90. Right, so the answer is a positive one. Task is to get a IRR. Therefore, should get a negative NPV. To get a negative NPV, increase this rate. Let's use 12%. The reason why I'm not using the formula itself to the calculation is if I use it, it has many other decimals, and that answer will not be equal to your answer. Then when you write the rounded figure and when you multiply, the two answers will not be equal. Therefore, I calculated it separately, and I'm going to type it here, 0.893. The discount factor of 12%. Second year, 0.797, 0.712, 0.636, and 0.567. Yes, as expected, a minus in PV. IRR formula. Start with the lower rate. Lower rate here is 10. Then what? Divide the numerator of the lower rate, which is 5.9 by 5.9, the same, minus the higher rate NPV, minus 1.19. So 2 times minus, which will be a plus sign, the second part of the formula, and finally multiply this by the rate difference, 12% higher rate minus 12 minus. I have taken out the percentage mark so that it will be easy. 12 minus 10. So IRR formula has 3 parts, the middle part, first part and the second part. So take the answer of the middle part, 5.9 over 5.9 plus 1.19. So the fraction is 0.83. Multiply that fraction by the rate difference of 2. The rate difference is 2. Answer is 1.66. Add 10 to 1.66. The rate is 11.66. Naturally, the 2 rates we used was 10 and 12. The answer must be these 2, because at 10 it is a positive NPV. At 12 it is a negative NPV. So the answer must be between 10 and 12, which is 11.66. I think I did not do, I can't remember whether I did an redeemable debt instrument cost calculation. I remember I gave this irredeemable formula, interest into 1 minus T over P0. But can't remember whether we did a question on IRR redeemable instruments. Now assume this is not a convertible instrument, but still redeemable, which means you will be able to collect your money from the company. Same calculation. You don't need to perform this step 1 and step 2. Calculate the cost of the debt, which is a redeemable instrument, your today's investment, the interest component that you will be able to get, plus year 5 cash payment. It can be at nominal as per the question, 100 only, or it can be nominal plus a premium, 105, such as this question. See, cash option is 105. So if it is with a premium, take that value as your inflow, expected inflow of the year 5. Yes, couldn't remind this an announcement. I remember last week I told during the lecture that the continuous assessment 2, which was shared with students, is subject to university's approval. Yes, the university has approved it, so you all can do it. I was expecting the approval anyway, but Formally I have to get the approval because it is not a group presentation. Therefore, I had to take the approval. So it was granted. Please go ahead and finish it early. Especially those who could not score good marks for the continuous assessment 1, please make sure to score good marks for the continuous assessment 2. Is the time enough? MBOs. Okay. Uh, the meaning of a management buyout is where the existing the members of the management team uh, they buy the company from its existing owners. Right now, the management team buys the company from the existing owners. In terms of the financing part here, in most cases, we see management buyouts not only financed by the existing management's own capital, but also with the involvement of a venture capitalist. It can be a venture capitalist, a person, or it can be even a financial institution or venture capitalist company, venture capital company. Because the funds that the management team has may not be sufficient to cover the consideration, and therefore they get the assistance of a venture capitalist or a financial institution. So the difference here is it is not acquired or purchased by another company, an outsider, like in a sell-off or trade sale, but it is by the existing management. So the institutions that are listed, or the institutions from whom the assistance, financial assistance can be taken for this type of transactions are, there are several here. It's listed several institutions specialize in providing funds for MBOs. These include the following: venture capitalists, banks, private equity firms, and other financial institutions. Now, who is a venture capitalist? as a person or who are or who is a venture capital company. Venture capitalists are companies or wealthy persons who have sufficient funds. They come and invest for a short, not for a longer period, maybe 5 years or maximum 10 years period. They invest their money when they see a very potential business. Now, for example, assume, okay, forget about this management buyout. You have a business, a small business, which is very potential, a very good demand for that product, very unique, and but you can't enhance the business because the capital is limited. You can't invest adequately on non-current assets. The capital is listed, but the product is unique and which has a very good market. So a venture capitalist can come into this business and invest their money in the business. It's like 99% of the investment, since your portion, your equity is very less compared to the money that they are bringing in. You will be the minority shareholder once invested. Say 95% or 90% of the funds are now owned by, or the shares are now owned by the venture capitalist. So the agreement is such that during that period, they will not stay forever. There will be a exit date as per the agreement. Say 5 years later or 10 years later, they'll exit. They'll take their investment out from the business and leave. But during that period, they'll be able to get the majority, 95% or 99% of the profits of the company as their return. And the benefit to the initial owners, you being the first owner, is that after their departure, your company or your business will be big enough to sustain in the business independently. The company has grown by that time, and you'll be able to earn more profits later. So you'll be the sole owner after that. But until that time, all the profits will be taken over by the venture capitalist. So the banks, you all know, the private equity firms and the other financial institutions can also come in as the finance providers for MBOs. Yes, here it is given here the details of a venture capitalist. Typically, venture capitalists will be prepared to advance funds to 5 to 10 years and will expect annual returns on their funds of 25% or more, because they expect a very high return compounded and received at exit rather than annually. They normally expect to take one or more seats on the board of directors as well. The specific types of finance and conditions attached vary from the investment to another, but key points to the considered include the following: the form of the finance, how they bring that money as equity or as any other source, their exit strategy, and by when and how they do it, and the support, the technical, that they can bring in the technical support also, or any other management support also they will be able to bring in. A question from management buyouts. BB is a listed company located in country B. It is a retail clothing business which operates a large number of branded retail stores throughout country B. Its functional currency is B dollars. BB currently has 5 distinct brands, each owned and managed by a separate business unit. Each business unit runs its own chain of retail stores. BB is seeking to sell QQ, one of these business units, in a management buyout. A selling price of B dollars 450 million that's the country's functional currency, dollars for 450 million has been agreed. That's a selling price of QQ SBU. It is anticipated that the effective date of the disposal will be 1st July 26. The managers of QQ have been in discussions with the bank and a venture capitalist regarding the financing of the MBO. The proposal is that the managers will put in $45 million of equity and the venture capitalist 180 million for class, let me hide this account. For class B equity shares with limited voting rights. So 180 plus 45 million is 225 million. Okay. Then the venture capitalist and the bank will each invest 112.5 million as debt finance. So 112.5 into 2 times is 225. 225 plus these 225 is 450. Yes. The venture capitalist expects a return on the equity portion of its investment of at least 25% a year on a compound basis over the first 4 years of the MBO. No dividends are to be paid during this period. Required. What is the minimum total equity value of QQ on 30th June 2030 required in order to satisfy the venture capitalist's expected return? Its expected return is 25%, right? It's yes, over the first 4 years of the MBO. Hmm. Okay, venture capitalists' equity value will be 180 million. The 112.5 million that they are going to invest in addition to the equity is debt. So our question is on equity. What is the minimum total equity value of QQ on 30th June 2030 required in order to satisfy the venture capitalist expected return? Therefore, 112.5 should be ignored because these calculations should be based on the equity value. So the venture capitalist is going to invest 180 million and they are expecting 25% year on compound basis. So it says the venture capitalists expect a return on the equity portion of investment at least 25% a year on a compound basis. Right. So then how much it should be? The value of the venture capitalist equity $180 million into 25%, right? Yes, 25. 1 plus G 1.25 and after 4 years. Power 4. The value would be 139.5. With this growth, it will be 139.5. That is the equity portion of the venture capitalist only. But the question is, what is the minimum total equity value of QQ? Total equity. Remember, there was a equity contribution from the managers. Equity contribution from the managers is how much? 45 million MBO. Therefore, what is the ownership percentage? Equity ownership percentage. $180 million is the investment. 180 plus 45. Ownership is 80%. The venture capitalist investment represents 80% of equity capital of QQ. Which means the gross equity of the company should be 439.5 over 0.8. Yeah, after X years or by that date, the total equity of the company should be increased to 549.3 for venture capitalists to get 25% return on a compound basis over the first 4 years. The total equity of the company should be 549.3, which means that 180 and 45 the initial investment must be increased to 549.3 by adding the retained earnings equity. The value of the equity must be this value for venture capitalists to get a 25% compound basis return for first 4 years on their investment. We have to rework and see. Now I converted the 180 into the future value, considering 25% growth for 4 years. And that value is equal to 80% of the total shares. And therefore 100% must be this value. Yep, see, did a different working here. First 4 years. Now assume, now let's work out, backward work out and see 149.3 is the value after 4 years of the business as of that particular date. From this equity, 80% owned by the venture capitalists, which is 439. What was the amount invested 4 years earlier? 180, and today's value is 180 was the value invested. And after 4 years, the value is 439.5. And year on year basis, 25% compounded value that is the total of these 4 figures, which is the difference between 180 and 439.5. It's as of on date 30th June 2030. And 180 is as of 1st July 26. That's the end of the topic number 8, presentation number 8. there'll be surely a question from long-term financing strategies, one of the major areas of your syllabus. Therefore, please study or collect more questions from this area and do those questions. There will be surely be a question from this area, and the question will not only be a calculation; it will be a combination, a calculation plus theory. By the way, a student requested me to get the help of or requested me to upload the last question paper. Is it now available in the LMS in your previous question papers section? I can't do it. It should be done by the university. Is it available? And I was told there are 3 question papers by a student that day. How many are there? Still 3 or?
Only 3 question papers available, sir.
Only 3, so that means not calculated. Okay, I will make sure that the last one will be uploaded. But the structure of the questions are very similar to the ones you have already. That there will be no change. Okay, let me. Okay, the attendance to is uploaded. Check. Okay. Did all mark your attendance? For those who couldn't get, please scan your QR code. QR code. Okay. Give me a minute, please. Okay, I'm sharing another question. I'm not going to start the next presentation. We have only two more presentations to cover the syllabus. One area is,
Hello, sir.
yeah,
Sir, can you please reshare the QR?
oops, I have logged out also. Okay. That is why I asked whether all have scanned the QR. Okay. Um, the next topic, we have a very small topic, which is on corporate restructuring. And that's, sorry, before the restructuring, we have financing new ventures, and the last one is corporate restructuring. Financing new ventures is a very small topic. And the last one would be corporate restructuring. Yeah, so we will have sufficient time to do some questions from all the areas of your syllabus. We will most probably be able to either to complete by next session, or maybe within 1.5 sessions we'll be able to complete the syllabus. Okay, the keyword was requested again. Can you mark now? Please scan the QR now.
I can't see the QR.
Am I not sharing? Yes. Can you see now?
Yes, sir.
Okay, please answer this question. One will do this question and stop today's lesson because the numbers are also less today. From a different presentation, which is not there in your presentation.
Thank you, sir.
Right, welcome. Read this question, 6 point, this is a different question, therefore don't take the number. We'll include this to the extra questions, therefore they take this as extra question number 3. PG Martin has $1,001 ordinary shares quoted at 4.5x div. It is considering a 1-for-5 rights issue at 4.2 per share. Calculate the TRP. Part B, assume that PGM intends to use the funds raised to finance a project with an NPV of 300,000. Calculate the theoretical X rights share price if the project is undertaken. Extra question number 3. Can I get the TRP answer, please?
4.45 for A.
4.45 for A. Did others also get the same answer?
Yes, sir. 4.45.
Right, okay. Part B, please. Yes, 4.45 must be correct. Let me check quickly. Extra question. What was the code we use? EQ. Yes. The minimum share basis. If you use the minimum share basis, to get 1, we need 5. So 5 into the market price. Ex-div prices are given market, which is 4.5. 5 shares into 4.5 plus 1 share at 4.2, and these two together is the numerator, should be divided by n plus 1. 5 plus 1. Yes, 4.45 correct. Total share basis 1 million shares. The current market price is 4.5, and they are going to issue fund 1 million divided by 5 means only 200,000 shares, rate of 4.2. Divide this numerator by 1 million plus 200,000 shares. 1.2. Same as part B. B. Anyone has an answer for this? Assume that PGM intends to use the funds raised to finance a project with an NPV of 300,000. Now, all previous questions what we did today for TRP calculations, which is the share price just after the rights issue, where the company, those companies did not have time to invest that collected funds, extra funds. The TRP calculation is always, remember, it is calculated, or if the examiner is silent on when to calculate TRP, at what point the TRP is, it is usually just after the rights issue. Thereby you get a diluted price. But the TRP can further be calculated after a while. Now in this case, they have invested those funds, how much it was, 200,000 into 4.20. Was it cash collected? Yes, 200,000 shares into 4.20. nearly.
4.7.
Are you referring to the answer, right?
Yeah, 4.7 for B.
Right. Right. Okay. So let me complete my explanation. So the company has collected nearly how much? 800,000 point two into 200,000 is 840,000. The company has collected cash, which is 200,000 shares into 4.2. 840 they have collected. So that money they have invested and they have managed to earn an NPV of 300,000, which is a positive answer, which means the present value of that investment must be more than 840 by 300,000. The present value of the inflows must be 11,040,000. 11,040,000 minus the investment of 840 is 300,000. Then the TRP or the value of a share must be more than what it was just after the rights issue. So you just need to increase, you just need to recognize the additional market capitalization or the value of the business. The additional value must be considered. Now, in terms of the total number of shares, before the issue, they had 1 million shares, and rights issue, it was 1 for 5, 1.2 million. So 200,000 shares altogether, 1.2 million shares they have after the rights issue. So the additional value they have managed to bring into the business is the NPV of the project. NPV, which is 300,000. 300,000 divided by 1.2 million shares will give you a value of how much? 0.25 per share basis. Right now, the TRP just after the rights issue was 4.45. Therefore, the TRP after the this is TRP just after the rights, and therefore the TRP after the investment would now be these two together. Yes, the answer, the student said the answer was correct, 4.70. If not, the market capitalization, the current or before the investment market capitalization just after the right issue is 4.45 into 1.2 million shares, which is 5,340,000. Then 300,000 new investment, which is then the total market value of the business is 5,640,000. Divide this by 1.2 million. Should get the same. Yep, 4.7. Any method can be used. Yep, that's all. So I will add this question also to the additional question handout. The number has come down to 39 after the attendance was taken. Okay, any questions you have so that you can ask? And we are not sure of the next week's lecture, but the university will inform that because I was told that not officially still there'll be a plan to have a Thai ceremony on the next Sunday. So not sure of still. If that is the case, they will probably reschedule the lecture, but you will get the official notice. By the way, did you get any notice on that yesterday?
So I was not clear about the second assignment. Could you please repeat again?
The second answer.
No, sir. I was not
Then-
clear about the second assignment. It is a
Yes.
quiz or the one you have uploaded to the LMS.
It is the LMS. It says very clearly CA2. Quizzes are no longer there in the LMS. You can't access to the quizzes now.
No, second quiz, sir. There is no
They are-
any second quiz, right? Is it?
No, why we did the quiz. We completed the quiz. For those who have not successful at the first attempt, there will be another chance of that will be a quiz, different questions, a quiz. But those details are not there in the LMS. What you will be able to see right now is the CA2, Continuous Assessment 2, a PDF document. Can you see that?
Yeah. Thanks.
Yeah, so that's
Clear.
that is not a quiz anymore. It is going to be a CA. It is read that the instructions. It is an individual presentation where you have to do it and record it and upload to the LMS. The maximum number of minutes, the maximum number of presentation slides, all are given there in the quiz. In the document itself. By the way, the question I asked, did anyone get to know about this next Sunday's plan of the university? Did they tell you all anything? No. Okay. Of course, they will let you know if we can't do the lecture on next Sunday, then of course we'll have to find an alternative day to do that. Yep. So that's all for the day. Let's meet again on the next day. Thank you. Bye-bye.
Thank you, sir.
Bye.
Thank you, sir.
Bye.
Thank you, sir. Thank you, sir.
Thank you, sir.